Hey everyone, my name is Jay Michaels. Welcome to the US Fast Track YouTube channel. Today we're going to be talking about Canadians and US taxes. I just was talking to a couple colleagues of mine going through this, and we didn't record it. And as soon as I was done, I was like, why did I not record this? So we kind of have a good setup here already. We're not going to go into too much detail. Little disclaimer, I'm not an accountant or a tax expert. This is just for educational purposes only. I just think it's needed to address because there's so much content out there that I would never recommend, or I've never even, all my accountants that I talk to, they've never really pushed any of that type of information, and we'll discuss that information. Here's my little diagram. Basically on the top we got Canada, that's the border, that's the US. Here's my little rental property on the US side. Now any rental income you make on the US side, you need to file taxes on the US side as well as Canadian side. A lot of issues come up. People talk about this double taxation. If you don't set up your income property correctly, yes, there will be double taxation. But if you set it up right, any income or taxes paid on the US side, you get credited on the Canadian side. And an important thing to remember that Canada has higher taxes than the US. So as long as you keep your US taxes lower than your Canadian ones, you're okay. And that's mainly because in Canada we got free healthcare, got to pay for that somehow. Some important dates, might be hard to see, but April 15th, that is our normal due date for Canadians in the US, but we get an automatic extension date to June 15th. Any taxes that are owed though are still due on the 15th, and if you pay them later, there's fees paid on top of that. When you're filing your taxes in the US, you need to have your US tax identification number, also known as an ITIN. Now if you don't have that before filing taxes, that's okay. You can file with your taxes. There's a little box that you fill out. A little diagram down here, I got a house, and you got two people that own it. If there's two people, like your wife and you on title, you need to file separate U.S. tax returns. There's two individuals, or it could be you and your brother, you and your sister, you and a cousin. Both people need to file taxes on there. Also, another important thing to remember on your rental income, the rental income, label it as effectively connected to the property. If you don't do that, you get taxed 30% of your gross rent on that property. So that's very important. That might wipe out your profit margins on your property. Also, another important thing, if you use your property anytime for personal use, so if you're down there for a quarter of the year and you rent it out for the rest of the year, for your expenses, you can only declare the percentage of actually in use for business. So it would be, on that case, it would be 75%. Also, you got to remember, if there's any, hopefully this doesn't happen, but if there's a net loss on your property, that's carried forward to the following year. So that's very important to remember, because that would help out next year. Okay, now this is probably the most talked about part that people always ask me is entity structure. And I have my I don't even like putting this on, writing this board on the board or anywhere on this piece of paper. Anyone ever seen this structure, LLC? I can't stress this enough, but I've read even Canadian books that say this is a good structure. This is the reason why they say that, or you might have read about this on the internet, is because 90% of content out there is for US people. And this structure is actually a really good structure for US people. We are not US people, we're Canadian. So what I usually tell people about LLC is do that to it, to get that out of your vocabulary. Now everyone's system is going to be a little different in the sense like everyone assets, what they owe and what they're trying to do in the US is definitely going to be a little different. But I'll tell you right now, that's not the best entity structure. Personally, if you're just buying, this is for the average Joe, if you're just buying one property or just trying to get into it, don't even worry about too much entity structure. You can just put in your personal name, and you will get the credit we were talking about on the US side and the Canadian side. Now, if you're worried about, obviously, liability, which like an LLC is limited liability company. That's why it's one of the best ones. It limits the liability. There's another things called LPs, limited partnerships. This is great. This works exactly like an LLC, but we will get the credit. Excuse me. We will get the credit on the US and Canadian side. I'll go back into LPs in a second, but so many people, sometimes I get this and it makes me laugh, is if you ever seen this, like they come to me and they're like, Mike, I have my, here's the border. They're like, I have my company here and we're going to have an LLC or something there, and that's going to own that, and that's going to own this, and you have this big web of entities. I kind of laugh because I'm just like, man, like, who are you, Donald Trump? Like, at some point, there's structures out there that this makes sense to, but like the average Joe is not, like, you don't need that. This costs thousands of dollars. I remember we were talking about this with my accountant. He said this is a $100,000 structure. And like if you're buying one property right now, it's so overkill. Like, accountants would love to do this because it's work for them. They got to do all the work. But what I stress is limited partnerships. You can have multiple partners in there, so it works great for joint ventures. Some of the important things in that forms-wise is you're going to fill out a 1065 U.S. return of partnership income. And also, your taxes are due on the 4th month, on the 15th day of your year end. So that's an important date to keep in mind. You're also going to fill out a K1 form, and that's basically saying each partner gets a K1 form. It's going to say, it's just information of what percentage they owe and what they can declare on the LP. And that's pretty much it. So also capital gains. If you own property for over a year, you're going to have to pay capital gains. The good thing is it's only max 15%, which is lower than Canada. So like I said, it falls into the whole, it doesn't really matter what you're paying in the US because you're always going to be paying higher in Canada. That's pretty much it. I'm not going to go into too much crazy detail because there's a lot more to all this stuff. But this is, I just find this is more educational than a lot of stuff out there, especially that LLC stuff. That's crazy. We should beep that every time I say it because that's not not cool. But thanks for listening. I hope this has gained some knowledge out of this. My name is Jay Michaels, and thanks for stopping by, and we'll see you on the other side. Thanks a lot.